Okay, so we're going to actually run a couple of exercises together here because oftentimes what happens in introductory level accounting courses is we spend so much time on exercises that involve calculations, we kind of lose sight of we're doing the calculations. So we're going to go through a couple of these exercises. I'm going to get done with this one here, and I'm going to switch out the piece of paper because I've got another one handy. And that helps you on multiple choice questions and these types of things, because one of the biggest issues is whenever we word a multiple choice question in such a way that you're trying to take an income statement item and put it on the balance sheet. And if you just have a little bit of a refresher from time to time as to where these various types of accounts go, maybe we can avoid that. So all they want us to do here, the second part of this video will be a little bit more challenging, but all we're doing right now is we're just trying to identify each of these, looks like 8 items, as B for balance sheet or I for income statement. And I'm going to also kind of tell you where these go as we're moving along. Again, B for balance, I for income statement. I'll go into a little bit more depth on that as we go though. So gain on bond retirement, okay? Gains add to net income. And these are in the other income and loss, interest revenue and interest expense items down at the bottom of the income statement. Okay, so gains are going to be on the income statement. B, discount on bonds payable. Discounts are an adjustment, or what we call a contra account, similar to accumulated depreciation. And so bonds payable are on the balance sheet. So the discount on a bond is an adjustment in the same portion. So the portion that would be non-current liabilities, unless we're in the last year of the bond. Okay, so C, mortgage notes payable. So as soon as we see the word payable, we know we have a liability, and hopefully we know that liabilities go on the balance sheet, and specifically this would be a long-term liability. Bonds payable, same story. We know it's a liability, and so therefore it belongs on the balance sheet. And specifically, the bonds payable is usually going to be a long-term liability. If it makes it into the last year, and then it becomes a current liability. Okay. E, bond expense. Anytime you see the word expense, that should be a dead giveaway to you that we are dealing with an income statement item. So when we pay interest expense, whether it's on a bond or not, that's going to be down in that bottom portion of a multiple step income statement, and this will reduce. This is not an operating expense. This has to go down at the bottom, but it is in fact on the income statement. Okay. Bond interest payable, due next period. We have a payable amount here, okay, and this is a balance sheet account, but you would probably do well to recognize that it is a current liability on the balance sheet. This tells us that it's a liability, but bonds, let's see, I'm sorry, I think I pointed at the wrong thing. The interest here is payable in no more than about a year, so it's going to current liability. Premium on bonds payable, this is an adjunct account, so it's kind of the opposite of a discount on bonds payable, but the bonds payable go on balance sheet, and the premium would be attached to the payable directly, so are added to it, and so we're probably talking about a long-term. It's not a long-term liability, but that's the portion of the balance sheet where it would be. and then a loss on bond retirement. Gain losses go down at the bottom of the income statement. So this next exercise is practically the exact same thing. I'll move this down here. These are all for bonds, so if you feel like you need some help with your financial statement classifications, then this will only get you a small part of the way. Okay, so gain on bond retirement of a material amount, we want to understand that, let's see here. So this is a drop-down box, and notice this is pretty long here. So these would get, whatever the answers are here, they're probably pretty specific. So I'm going to say IS for income statement, other income and expenses, comma, gains and losses. Okay? And in this case, we would be talking about a gain. Discount on bonds payable, we talked about this already. Balance sheet. Contra account to the bond payable itself. And this is going to be a long-term liability. Mortgage notes payable, balance sheet, and then we would say, what we would really say is that this is going to be mostly a long-term liability, and then the portion due in less than 1 year is going to be a current liability. Again, this is not going to match up to what these drop-down choices are, but we're just trying to get practice, okay? Bonds payable. This is a balance sheet, long-term liability, unless we're in the last year of the bond, in which case, if that were true, it would be a current liability, but this would be a long-term liability based on the information we have. Bond interest expense, as all expenses go on the income statement. And then see number 1 above. That's a lot of stuff to write. Other income and expenses, gains, and bond interest payable. This is balance sheet, but this is going to be a current liability because we're going to have to pay that interest in either 3 months, 6 months, or a year. Premium on bonds payable, balance sheet. It's an adjunct account, so it would, the bond payable is probably going to be a long-term liability. And I'll just write out here, this is an adjunct account. And let's see, where was the other one that we had? Okay, so I got contra account up here, an adjunct account here. So that gives us a little bit of, I wouldn't call it theory, but we need to understand, you know, if you got a question that is trying to give you, you know, we're talking about a discount on bonds payable, you know, where does that go? It goes in the liability section. Is it a liability? Is a discount on bonds payable a liability? No, it is not. But the question is asking you, where does it go? Well, it goes on the balance sheet under most likely long-term liabilities, unless you were told that the bond was about to mature. Okay, so hopefully you got something out of this exercise. I sure had fun with it, and thanks for watching.